Online real estate firm Redfin announced that the total value of U.S. homes increased to a record $46.8 trillion in June, surpassing the previous all-time high of $46.6 trillion a year earlier, as a lack of listings supported prices. Today we're going to discuss housing market rebound. Total U.S. home value hits $46.8 trillion in June. The decision between flexible and fixed communities affects the housing market's characteristics. The frontier models presume that land is infinitely available at a fixed or no cost, making the land market irrelevant. Simply said, the housing services merge into the composite good. In contrast, a fixed community model might make the housing market a key component, particularly if the number of dwelling sites is fixed. A housing market also makes it possible to use local property taxes to pay for public services. Typically, the functioning of housing markets precludes a fixed community economy from reaching its first best optimum. This is particularly true in scenarios where property taxes are present because these levies themselves cause distortions. Even though the summer has been extremely hot across much of the nation, the housing market is still barely moving. In the second week of August, the average 30-year fixed mortgage rate in the country crept closer to 7%. By the week ending August 10th, it had risen to 6.96%. According to the National Association of Realtors, NAR, the median existing home sales price also surpassed $400,000 for the first time in 2023, reaching $410,200, the second highest price ever recorded, and is currently on pace to break the all-time high of $413,800 set in June 2022. Existing monthly house sales, however, fell by 3.3%, with sales falling in all four of the major U.S. regions on a yearly basis. Despite rising mortgage rates, the market is nevertheless highly competitive because of high consumer demand and a limited supply of available properties, in part because homeowners who bought houses at historically cheap interest rates in recent years have decided to stay put. These and other elements combine to create the ideal affordability problem storm that keeps many would-be homeowners at a disadvantage. The real estate industry is recovering, and the reason for that is that there aren't enough houses on the market, which drives up housing costs and drives up property values to the $47 trillion threshold Redfin claimed. The problem is that a lot of homeowners are sitting on lovely low rates, which makes a lot of them very hesitant to sell. The fact that there are so few homes available for numerous buyers to choose from prevents the decline in home values. The West Coast, specifically the tech hub and the pandemic boomtowns like Phoenix, saw the biggest drop in home values because they are among the most expensive markets out there, meaning that home values have a little bit of that wiggle room to fall. Regionally, Atlanta, Boston, and Miami are posting the biggest jump in home values. However, when viewed as a percentage, Little Rock, Arkansas, Camden, New Jersey, Milwaukee, Wisconsin, and Wilmington, Delaware are among the other locations where property values are soaring. That is merely a partial list. In these markets, home values did not rise too much. In terms of housing values, they haven't actually witnessed a sharp decline. Some homeowners have made some tremendous gains recently. Only 8% of homes are worth more than $700,000, and Redfin confirmed that. The number of properties valued seven figures fell precipitously in February, reaching a 12-month low. At 8.6%, the proportion of million-dollar residences is currently at an all-time high. Home values are rising as a result of high housing costs and a lack of available inventory. And one economist stated that you should expect a bidding battle if you have a great home that is in good condition and priced reasonably. In general, there isn't much of a rush to sell a high-value home. Additionally, it's important to keep in mind that the possibility that the U.S. would avoid a recession now may eventually increase demand elsewhere. The home market has now recovered from a $2.9 trillion value decline that happened from June 2022 to February 2023 and was caused by rising mortgage rates. Many homeowners secured lower mortgage rates before borrowing prices started to soar last year, encouraging them to stay put because relocating would result in paying a considerably higher rate. As a result, only 1% of homes in the United States were sold this year, which is the lowest percentage in at least 10 years, according to the research. Additionally, the number of homes for sale decreased 15% year over year to a record low in June, marking the largest yearly loss in nearly 2 years. According to Chen Zhao, Redfin economics research head, buyers who are in the market now are vying for a very small pool of homes, preventing home values from plunging. Affordable regions like Little Rock, Arkansas, and Camden, New Jersey experienced the largest YY increases in value, whilst pricier metropolitan areas like Los Angeles experienced the greatest declines, with the total value of homes rising to an astonishing $46.8 trillion in the month of June. The comeback of the U.S. housing market has been nothing short of astounding. This rebound is proof of both a stunning rise above the pandemic's difficulties as well as the lasting power of the U.S. real estate market. The housing market is an essential part of the American economy, and it has wide-ranging implications that go far beyond real estate. The increase in property values is a positive development since it reflects not just the worth of real estate, but also the general optimism of investors, homeowners, and people in general. This amazing accomplishment is proof of the housing market's resiliency and proof that it can overcome even the most difficult obstacles. This revival is being fueled by a number of interrelated factors. Mortgage interest rates are one important aspect. A wider portion of the population can now afford to buy a home thanks to the Federal Reserve's decision to keep interest rates low in reaction to the economic turmoil brought on by the epidemic. In turn, this has increased demand for properties, pushing up prices in a market with limited supply. The dynamics of the property market have also been shaped by the pandemic itself. Lockdowns and extended remote work periods forced many people to reevaluate their living arrangements. With the ability to work from anywhere, some urban residents sought out larger homes in the suburbs or in the country, which increased demand in these regions. The demand for single-family homes was also spurred by the need for more room and amenities inside one's home, which increased their worth. But the supply has had a hard time keeping up with the demand. The epidemic caused interruptions in various industries, including the building sector. Construction projects have been delayed as a result of supply chain problems, labor shortages, and rising material costs, which has decreased the supply of new homes hitting the market. The imbalance between supply and demand has contributed to the rise in housing values. The rising housing values have also been attributed to investor activity. The uncertainty caused by the pandemic encouraged many investors to seek security in real estate, which has long been seen as a secure investment. Individual and institutional investors' increased demand has increased competition for available houses, pushing up prices even more. It is interesting to see the regional diversity in the housing market recovery. Some places have witnessed more moderate growth in housing values, whereas several metropolitan areas have seen large increases. The trajectory of the comeback on a regional level has been impacted by a variety of variables, including demographic patterns, regional economics, and governmental initiatives. It's critical to be aware of any difficulties that could result from the quick increase in home values. As prices surpass income growth for many Americans, concerns about affordability have increased. Discussions about the inclusiveness of the housing market's recovery and the requirement for policies to guarantee that homeownership remains affordable for a wide range of income levels have resulted as a result of this. Furthermore, it is impossible to overlook the threat of a housing bubble. The sustainability of this rise may be questioned given how quickly housing values have increased. To avoid the kind of market volatility that characterized the 2008 housing crisis, policymakers, economists, and industry professionals will need to regularly monitor the market. In conclusion, the amazing recovery of the U.S. housing market, with a total home value of $46.8 trillion in June, is a complex phenomenon caused by a number of causes. Low interest rates on mortgages, changes in home preferences, supply limitations, and investor demand have all had an impact on how the market has developed. While the comeback denotes a robust recovery and economic resiliency, it also raises crucial issues like affordability, regional differences, and the possibility of market overheating. Stakeholders must strike a balance between the advantages of expansion and the long-term need for inclusion and stability as the housing market continues to change. That's all about today's video. If you like this video, don't forget to like and subscribe to our channel. Also, press the bell icon to get notified of our upcoming videos. Let us know your opinion in the comments section below.